put options, call options, in the money options, out of the money options, and how do I make money from trading options. In today's video, we are going to be talking about and giving a few life examples on how an options contract works. Catch it today. Hey guys, so I've been getting a lot of questions recently about what options contracts are. Obviously, if you follow me on Instagram, you'll have seen that I've been trading SPY options quite frequently. SPY options simply are options that trade based off of the ETF for the S&P 500, and it's a great way to usually make a decent sized return in a short period of time. Options obviously are a lot more risky, and this is not financial advice as to get into options, especially as a new trader. I think my advice would be steer clear of options, but I want to explain what options are and why they can be beneficial to a lot of people and why they do have an upside of risk, because let's face it, anytime that there's a greater potential for reward, there's always going to be a greater potential for risk. So I think the best way to start about talking about an option is that there are two types of options, especially a lot of you that are in Robinhood, you know that you can go trade options and it'll ask you if it's going up or down, and they try to really walk you through it very simply. Basically, a put option is going to be a negative option. That is going to be a way for you to make money if a stock is going down. It's an alternative to actually shorting a company where brokers like Robinhood don't give you that ability. To me, I just, like I said, I don't like a lot of stuff about Robinhood, but their options trading is decent, and options can be pretty expensive. A call option is going to be an option where you actually make money on the upside if you're correct in your thesis and you're not buying a super cheap option that is really far out of the money. You have the ability to make a lot of money. Best way to explain an option is that an options contract is going to be similar to this scenario here. Let's say that I own, for example, an alarm dealership. I sell home security systems, right? Let's say that the home security business that I own is worth $2 million. Now, I am in a situation where I need to raise extra money right now. I'm looking, and there's an investor that comes to me and says, hey, I see that your company is worth $2 million. I would like to buy 50% of your company. And I go, I need that $1 million. Half of $2 million is $1 million. And I go, you know what? That's kind of a good bet. But in my mind and in my heart of hearts, I believe that over the next few years with this capital, I am going to be able to make this company worth more money. What I can do is I can exercise an options contract with this investor. I could say, hey, what I'm going to do is for the next 5 years, you give me the option to buy you out at any given point. For that, in exchange, I will give you $50,000 to have the option to exercise my right to buy out your $1 million stake in this company. How that benefits me is, yes, I'm saying, hey, up front, you're going to get a $50,000 paycheck no matter what. But what that does is that gives me the ability that if the company's valuation is higher than the $2 million anywhere during that 5-year period, I can exercise that contract. Let's say that the company is now worth $6 million. It's 3x its growth. I can now buy that 50% portion of that company, my alarm company, back for $1 million as opposed to needing to pay him, let's say $3 million actually to buy out that additional stake. So that's a great example of what a call option is going to be, and you do pay a premium for that. One of the things that I do want to mention with that, though, is that there is time decay. Anytime you're buying an option actually in the stock market, there's something called time decay. That means the sooner or the further out an option is placed, the more expensive that option is going to get. Because, as we know, especially in the stock market, stocks do tend to go up more over time, or you have the ability to foresee what's going to happen. There's more chance of the hypothesis or your thesis will actually happen. If I have a call option on Apple and I buy it for 2 years down the road, the stock's trading at $150, and I believe that the stock is going to be at $170 in 2 years, I'm going to be pretty certain that that's going to happen. Those options get more and more expensive, and you have to pay a larger premium for those options the further out you buy. The closer you buy those options, let's say you buy that option for Apple again, and it's $150 right now, and you're saying that that price is going to be at $170 in a week, the option price to buy that option is going to be very small, because the reality of Apple actually going up $20 in 2 weeks is going to be a lot slimmer than if we're talking about a year or 2 years down the road. In our second example, we are going to be talking about a call option. So here's another great example. I own, again, an alarm company. I have someone that comes to me. I've been thinking about needing to take on an additional partner to help cover some of the expenses, help burden some of the financial load. And so I decide to take on a financial investor. Now, let's say that I take on this investor and he has a 50-50 stake in the company. Now, I don't really like this guy. Let's say I don't trust this guy. I don't believe that he's really has my best interests at heart and doesn't have the best interests of the business at heart. So what I could do, again, the company, my alarm company, is worth $2 million. With this options contract, or this put option, what I would do is I would stipulate that, again, in 5 years' time, I have the ability to buy out the company or the rest of his stake for $1 million again. Now, in this, I'm going to pay him a premium, let's say again, of $50,000 for that premium. So the company, we're saying, is worth $2 million. I own $1 million of the company. My sketchy business partner owns the other 50% of the business company. And we go together in this business venture. Well, let's say 6 months down the road, he decides that he does not like the way that the salesmen are going out there. He gets in a fight with the regional manager. He doesn't like some of our managers that are managing the offices. And he goes, you know what? I'm going to fire them. We don't need them. We can get better guys. We can do things through online marketing. And so he destroys and ruins those relationships, those guys that were bringing us sales and bringing us new accounts. Well, let's say what happens is then after that first year, the company just starts to tank. We were doing really good without our regional manager, without our managers. The company sucks now. What I can do is, with that options contract, again, I paid $50,000 that over the next 5 years, I have the ability to get my share of the company or sell my share. In a put, I have the ability to share or sell my share of the company to this investor for $1 million. That guarantees that this company, I can still get my $1 million back. Well, after a year, this investor has destroyed the company. Instead of this company being worth $2 million, this company is now only worth $500,000. That would mean that my stake in the company is now only worth $250,000. His stake is only worth $250,000. With my put option in this company, I can actually now sell my 50% stake of the company to the investor for $1 million, or 4 times the market value of the company, because this investor screwed up the company. That, in a nutshell, is the difference between a call and a put option. Now, this is a kind of real world scenario situation. This is not actually how an option contract works in the market, but this is a good idea of what a put and what a call option is, in terms of contracts and values. Now, here's a great example. We're going to take a look at Robinhood, and we're going to take a look at some of the options pricing and how you can purchase some of the options here on Robinhood. So as you can see, we're looking at the S&P 500 ETF, or SPY calls. You can either buy calls or you can sell them. I would not really mess around with those if you're not an advanced trader. But if you are to buy a call, you're buying basically the option to buy the stock at a cheaper price than what it actually will be selling at, which means you make more money on it. If you're buying a put, you're exercising or will have the ability to sell the share price at a higher price than where it is currently at. Now, as you can see, currently the S&P 500, or the SPY for this ETF, is right at $272.89. As you can see, if you are buying options, you have strike prices. The break even will tell you where the price would have to be in order for you to break even. So currently, if you wanted to buy this one, you're looking at, it would have to be from 272.89, it would have to go to 274.42. You would have to basically make 0.56%. And you are also looking at a change of 50% on the day. You're also going to see the change in price, and you're also going to see the price of what that current option is going for. So these are some things in my course video. I'm going to explain this a little bit better. You're going to be able to see exactly what these all mean, and I'm going to give a few more examples of kind of more in-depth and more detail. Now, as you can see, this was yesterday's call option. So actually on February 4th, so I guess this will be 2 days ago. No, this was yesterday's. I had bought an options contract One was at $4 for a $266 call. Now, if I would have held that call, I would have made a lot more on it. But you'll see right here that I bought a call for $4. One contract is equal to 100 shares. So it is 100 or $4 times 100, and that's where it gives you your cost of that option. That one option is $400. You can see that I was not able to buy any in here. I was trying to sell it a couple times. I'd also bought another contract that was a $266 call on the 6th as well, or sorry, that was going to expire on the 6th, but I bought that on February 4th, and that contract at that current time was $3.83. So as you see, I bought one for $383, another one for $400. That would be a total cost of $783. Well, as the day went on, the price of the S&P 500 or the overall market went up. What happened was it went up. My calls now were worth $4.94 for those calls, and I ended up actually selling those out, those two contracts, for $4.94. Now again, you multiply that by 100 times 2 because I own two contracts, and it gave me a total payout of $988. Well, $988 minus the 400 here, minus the 383 here, would give you a total of about $205 profit if my math is correct. That is why options are very nice. It's very easy to make a decent return on that. I think my return was 21%. And if we did the time on there, I would probably say I held those options for probably somewhere right around 3 or 4 hours. So it was a very short-term trade. You got to know when you're in the money and when you're out of the money. Some people like to trade massive, far out of the money options. That to me is a little bit more risky because I could potentially completely lose all my money, and that is something you need to think about. Is with options, if your strike or your date is February 6th, that is when the expiration of that option is. So if you have not met that current price and you are not in the money, what that means is your option expires worthless. So I bought this option for $400 and this one for $383. If the price of the stock was not over $266, I would have lost all of my money. Those options would have expired worthless. I would have had no money made on that. Whereas if you buy those options closer to the actual price of the stock, you're going to pay a little bit more for that options contract, as we talked about in our earlier example, but your returns are not going to be nearly as large. So if I were to buy options that were further out of the money, that would mean that the potential to make more is obviously there, but the potential to lose everything is also there as well. And there you have it, guys. That is basically the logistics or basics of an option. How it is, how it plays out. I hope you found this helpful. I hope you found this insightful. If you did, please give it a thumbs up. I'd obviously appreciate it. If you have any more questions, if you're interested in my course, which will go into this a little bit more in depth, along with a lot of other trading strategies, including long-term investing, swing trading, how to read charts, technical analysis, all those things. I want to give you a ton of value. That is all going to be in the course. If you have questions, feel free to message me in the comment section, DM me on Instagram, follow me on there. I love to post all my trades and stuff on my Instagram story, and become a member of We Trade HQ. It's a free group. Lots of great traders in there. Other guys different than me. Brad does a lot of OTCs. We have people that do crypto. We have all sorts. So if you're into investing, join We Trade HQ. It was so fun getting to talk to you guys. I hope you find this insightful, and I will catch you in the next video. Bye.